Mr. AG Asian Guy here. Gold just crashed below $5,000. Silver collapsed over 5% in a single session. And the reason this happened tells you everything you need to know about who really controls this market. Today is Tuesday. China's Lunar New Year holiday just kicked off. The Chinese buyers who have been supporting precious metals prices for months are now on vacation. And without them, gold and silver are falling apart. This is not a coincidence. This is not random volatility. This is a live demonstration of exactly how dependent the precious metals market has become on Asian demand, particularly Chinese demand. And what happens over the next week while China is closed could set up the next major move in both directions. Let me give you the numbers because the specifics matter. Gold futures fell 2.2%, down $109.30 to $4,136 per ounce. This comes after gold gained 1.43% last week to finish at $5,022 per ounce. Gold has gained in 8 of the past 10 weeks. That's an incredible run. But today it gave back a significant chunk of those gains in a single session. The $5,000 level that everyone was watching as psychological support just broke. Silver got hit even harder. Silver futures slumped $4, down 5.2% to $73.92 per ounce. Let me say that again. Silver lost over 5% in one day. That's the kind of volatility that silver is known for, but it's also the kind of volatility that destroys traders who aren't prepared for it. When silver moves, it moves hard. Today was a perfect example of that. Copper fell 2.3% to $5.668 per pound. Platinum slumped 4.2% to $1,088 per ounce. Across the board, metals are under pressure, and the common thread connecting all of these declines is the same. China is on holiday. The buyers who have been driving prices higher are temporarily absent. And without them, the market is showing you exactly how fragile the support really was. Before we go any further, let me tell you what this channel is about. I don't sell courses, I don't sell signals, I don't sell anything. What I do is break down market data, show you both sides of every argument, and give you the framework to make your own informed decisions. I'm not here to pump your bags or scare you out of positions. I'm here to help you understand what's actually happening so you can navigate these volatile markets intelligently. If you want hype, find another channel. If you want fear porn, find another channel. I'm here for people who want to understand the forces that move these markets. Now drop a comment right now. Where are you watching from today? I want to know what country, what city. I see viewers from all over the world on these videos. United States, Canada, United Kingdom, Germany, Australia, India, Singapore, Philippines, Hong Kong, Japan, South Africa, Brazil. Let me know where you're tuning in from. And tell me, are you buying this dip or waiting for lower prices? What's your read on what happens when China comes back? I want to hear from you because the community's perspectives often catch things I miss. Let me explain why China's absence matters so much, because this is the key insight that most people don't fully appreciate. Ole Hansen, the head of commodity strategy at Saxo Bank, put it perfectly. He said, and I quote, "The move highlights the importance of Asian and especially Chinese demand, which helped propel prices higher in recent months," end quote. This is not speculation. This is an institutional analyst telling you directly that Chinese demand is the primary driver of recent precious metals gains. Hansen went further. He said, quote, "January's parabolic advance, driven by strong regional demand and investor flows, was followed by an equally historic correction. With the marginal buyer temporarily absent, metals are now struggling to regain momentum," end quote. The marginal buyer, that's the key concept here. Let me explain what that means because it's crucial for understanding market dynamics. The marginal buyer is the buyer who sets the price at the edge. When supply and demand are roughly in balance, the marginal buyer is the one whose decision to buy or not buy determines whether prices go up or stay flat. In precious metals, particularly over the past year, Chinese buyers have become the marginal buyer. They've been accumulating gold through central bank purchases. They've been trading arbitrage opportunities between Shanghai and Western markets. Chinese households have been increasing their allocation to gold as confidence in real estate and domestic investments has declined. When that marginal buyer goes away, even temporarily for a holiday, you see what happens. Prices fall because there's no one at the margin stepping in to absorb selling pressure. The other buyers are still there, but they're not enough to maintain prices at these elevated levels without Chinese participation. This is a structural insight about the market that matters far beyond this single holiday. Let me give you the key support levels because this is what you need to watch over the next week while China is closed. For gold, Hansen identifies support near $4,860. Below that, the next level is $4,670. So we're currently at $4,936. First support is $4,860, about $76 lower. Second support is $4,670, about $266 lower. These are the levels where institutional buyers might step in. If we break through both levels while China is on holiday, that would signal serious technical damage that could take time to repair. For silver, the picture is more concerning. Hansen noted that silver's lower highs suggest weakening momentum and potential downside towards $70. We're currently at around $74. The $70 level is the next major support. If that breaks, we could see significant further downside. David Morrison, a senior market analyst at Trade Nation, described silver's behavior today as, quote, exhibiting oversized intraday volatility as traders knock it around as they attempt to find clear areas of support and resistance, end quote. He said that could mean $70 is retested soon, or that dip buyers come in to take advantage of lower prices once the U.S. reopens. This is the uncertainty we're dealing with. We have clear support levels to watch. We know the marginal buyer is absent. We know volatility is elevated, but we don't know which way it breaks from here. That's why I always present both sides. That's why I give you the levels to watch. So you can make informed decisions based on what actually happens rather than what anyone predicts will happen. Let me talk about the dollar, because this is a critical factor that could determine what happens next. As gold dropped, the dollar was slightly stronger. The ICE dollar index was up 0.2% to 97.15. The dollar and gold often have an inverse relationship. When the dollar strengthens, gold typically weakens because gold is priced in dollars and becomes more expensive for international buyers. When the dollar weakens, gold typically strengthens because it becomes cheaper for international buyers and serves as an alternative store of value. But here's where it gets interesting. Hansen pointed out that while a weaker dollar in recent months has supported hard assets, positioning has increasingly become one-sided. Bank of America's latest FX sentiment survey shows fund managers holding their most bearish dollar stance in a decade. Let me say that again. Fund managers are holding their most bearish dollar positioning in 14 years. This is the most extreme bearish sentiment on the dollar in 14 years. Hansen said, quote, such consensus does not guarantee a reversal, but it raises the risk of a counter-trend rebound, end quote. This is important. When everyone is positioned the same way when the trade becomes crowded, the risk of a reversal increases. If the dollar bounces from these levels, that would create additional headwinds for precious metals on top of the Chinese absence. A strengthening dollar plus absent Chinese buyers could push gold and silver significantly lower. Bank of America's February Global Fund Manager survey also showed that a long gold position among those investors was the most crowded for the second straight month. So we have the most bearish dollar positioning in 14 years and the most crowded long gold positioning for 2 consecutive months. Both of these extremes raise the risk of counter-trend moves. When everyone is long gold and short the dollar, who is left to buy gold and sell the dollar? The incremental buyer and seller become harder to find at these positioning extremes. Quick pause here. I want to ask you something. Were you aware of how crowded these positions have become? Did you know that fund managers are holding their most bearish dollar stance in 14 years? Drop your thoughts in the comments. This kind of positioning data is crucial for understanding what could happen next. And I want to know if this changes your view. Now let me talk about the bigger picture, because despite today's decline, the structural drivers for gold remain in place. Hansen acknowledged this explicitly. He said that central bank buying and rising government deficits and sovereign debt levels reinforce gold's store of value characteristics. The short term can be volatile. The short term can be driven by positioning and sentiment and the presence or absence of specific buyers. But the long-term structural case hasn't changed. Let me give you some context on the magnitude of gold's recent rally. Gold has been one of the defining market stories in recent years. The SPDR Gold Shares ETF, trading under the ticker GLD, has rallied over 175% since October 2023. Let me put that in perspective. The SPDR S&P 500 ETF, the SPY, has returned about 75% over the same period. Gold has more than doubled the stock market's return. This is not normal. This is not typical. This is a generational move in a traditional safe haven asset that has outperformed equities by a massive margin. Goldman Sachs released a report led by analyst Lena Thomas, suggesting that the gold rally may indicate broader trends in the commodity market beyond its traditional role as a safe haven asset. They're seeing gold's move as signaling something larger about the monetary system, about confidence in fiat currencies, about central bank behavior. This is institutional validation of what many in the precious metals community have been saying for years. Now let me get to the China data because this is where it gets really interesting. Societe Generale estimated China's gold accumulation to be as much as 250 tons in 2025 when measured through trade flows. 250 tons. That makes China responsible for more than 1/3 of global central bank demand. One country is responsible for over 1/3 of all central bank gold buying. That's extraordinary concentration. But here's the critical insight. Beijing's approach seems designed to limit transparency. Most analysts doubt that the reported monthly figures truly reflect actual purchasing activity. China reports official gold reserve increases that are far below what trade flow data suggests they're actually buying. They're accumulating more gold than they're publicly acknowledging. Why would they do that? Probably because they don't want to move the market against themselves by signaling their full buying intentions. Probably because they want strategic optionality. Probably because they're preparing for something that they don't want to telegraph in advance. And then there's the bombshell from Treasury Secretary Scott Bessent. He indicated to the Senate that China might be developing gold-backed digital assets in Hong Kong instead of using the yuan. Let me unpack what that means because it's significant. China could be creating a digital currency that's backed by physical gold. Not backed by faith in the Chinese government, not backed by yuan, backed by actual gold. Issued through Hong Kong's financial system, which has more international credibility than mainland China's financial system. If China launches a gold-backed digital currency, that would be a direct challenge to the dollar-based monetary system. It would give international trading partners an alternative to dollars that has the credibility of gold backing. It would accelerate the de-dollarization trend that we've been watching, and it would explain why China has been so aggressively accumulating gold while understating their actual purchases. They need the gold to back the digital currency they're building. Torsten Slok, the chief economist at Apollo Global Management, has suggested that global central banks may soon hold more gold than US dollars as a reserve. Think about what that means. For decades, the dollar has been the world's primary reserve currency. Central banks held dollars as the foundation of their reserves. But if Slok is right, we're approaching a tipping point where gold becomes the primary reserve asset and dollars become secondary. That would be the most significant shift in the global monetary system since Bretton Woods. Let me ask you another question. Do you think China is building a gold-backed digital currency? Does that theory make sense to you given their behavior? Drop your thoughts in the comments. This is speculative territory, but the evidence is pointing in that direction, and I want to know what the community thinks. Now let me give you the bearish case because I always present both sides. Here's what could go wrong from here. First, China's holiday lasts about a week. That's a full week without the marginal buyer. If selling pressure continues each day, we could see significant technical damage before Chinese buyers return. Gold could test 4,160 or even 4,670. Silver could test 70 or lower. Second, the crowded positioning could unwind further. With the most bearish dollar positioning in 14 years and the most crowded gold long positioning for 2 consecutive months, we could see a positioning squeeze. If the dollar bounces, if gold longs start reducing, the unwind could be violent. Third, the technical picture is weakening. Gold broke below 5,000. Silver is making lower highs. These are warning signs that momentum is shifting. Technical traders who follow these patterns will sell into weakness, adding to downside pressure. Fourth, the absence of Chinese buyers reveals how dependent the market has become on a single source of demand. If anything changes with Chinese buying, whether due to policy shifts, economic problems, or geopolitical tensions, the support disappears. Fifth, profit-taking after a 175% rally since October 2023 is natural. Many investors who bought gold lower have massive gains. Some will want to lock in those gains, especially if momentum is weakening. Sixth, if silver breaks $70, that could trigger stop-loss selling and margin calls that accelerate the decline. Silver's 5% move today shows how quickly things can move. Another 5% day lower would put silver in the mid-60s. Seventh, the gold-backed digital currency theory could be wrong. China might just be accumulating gold as a traditional reserve diversification strategy without any plans for a digital currency. The Bessent comments could be speculation rather than intelligence. These are real risks. I'm not dismissing any of them. The bullish case is not guaranteed. Now here's the bullish case. First, the structural drivers remain in place. Central bank buying continues globally, not just in China. Government deficits are expanding. Sovereign debt levels are rising. Currency debasement concerns are growing. None of this changes because of a one-week Chinese holiday. Second, China comes back. In about a week, Chinese markets reopen. If Chinese buyers return aggressively, all of this weakness gets reversed. We've seen this pattern before where prices correct during Chinese holidays and then rally when they return. Third, the dip creates buying opportunity. When prices fall 2% or 5% in a day, long-term accumulators see opportunity. Morrison mentioned that dip buyers could come in once the U.S. reopens. Lower prices attract buyers who think the long-term case is intact. Fourth, 175% rally context matters. Yes, gold has rallied 175% since October 2023, but that doesn't mean it's done. If the structural case for gold is monetary system transformation, de-dollarization, and central bank accumulation, the rally could have much further to go over the coming years. Fifth, China's 250 tons of accumulation in 2025 alone shows they view gold as strategically important. They're not accumulating that much gold to sell it. They're accumulating for long-term strategic purposes. That's a structural bid that persists. Sixth, the gold-backed digital currency possibility represents a paradigm shift. If China is actually building this, gold becomes even more strategically important. Demand would increase as backing for the new monetary instrument. Seventh, key support levels may hold. Gold at 4,160 and 4,670 are significant levels where buyers may step in. Silver at 70 is a round number, psychological support. These levels could contain the correction. Eighth, the most bearish dollar positioning in 14 years doesn't mean the dollar rallies. It means the risk is elevated. But consensus bearish positioning can persist for extended periods if the fundamentals support it. And the fundamentals of expanding U.S. deficits and debt do support dollar weakness long term. Here's what I'm watching over the next week to determine which scenario plays out. First, the gold 4,860 level. Does it hold or break? This is the first major support. If it holds, the correction may be limited. If it breaks, 4,670 comes into play. Second, the silver 70 level. This is critical psychological support. A break below 70 would signal serious technical damage and potential for further downside. Third, dollar price action. If the dollar continues strengthening, that's a headwind for precious metals. If the dollar weakens despite the bearish positioning, that's supportive. Fourth, trading volume. Is the selling happening on high volume or low holiday volume? High volume selling suggests conviction. Low volume selling suggests the move could be easily reversed. Fifth, price action when China returns. This is the most important data point. When Chinese markets reopen after Lunar New Year, do we see buying or selling? Strong buying would suggest the correction is over. Continued selling would suggest something has changed. Sixth, any news about Chinese gold policy or digital currency developments, any confirmation of the gold-backed digital asset theory would be massively bullish for gold. Let me bring this back to practical application because that's what matters. What do you actually do with this information? If you're a long-term holder who accumulated gold and silver at lower prices, this correction probably doesn't change your thesis. You're up 175% on gold since October 2023. A 2% or even 5% daily decline doesn't erase that. If you believe in the structural case for precious metals, you hold through the volatility and potentially add on weakness. If you're looking to enter positions, this could be an opportunity. Prices are lower than they were last week. If the structural case is intact and the correction is driven by temporary absence of buyers rather than fundamental deterioration, buying the dip makes sense. But wait for confirmation of support at key levels rather than catching a falling knife. If you're trading, respect the volatility. Silver moved 5% in one day. That's enormous. Position sizing should account for the possibility of continued 5% daily moves. Stop losses should be wide enough to avoid being stopped out by normal volatility, but tight enough to limit damage if the trend has truly changed. If you're concerned about risk, remember that positioning is crowded. The most bearish dollar stance in 14 years and the most crowded gold long for 2 consecutive months means lots of people are on the same side of these trades. Crowded positions can unwind violently. Risk management is crucial. One more question for you. Are you positioned in gold or silver right now? Are you planning to buy this dip, or are you waiting for more clarity? Drop your approach in the comments. I want to know how real people are thinking about these moves because that tells us something about market sentiment. 3 key takeaways and we're out. Number 1, gold crashed below $5,000 to $4,136, and silver fell 5.2% to 73.92 because China's Lunar New Year holiday removed the marginal buyer from the market. Ole Hansen from Saxo Bank explicitly stated that Asian and especially Chinese demand propelled prices higher in recent months. With that demand temporarily absent, metals are struggling to find support. Key levels to watch are gold at 4,161st support and 4,670 second support. Silver has potential downside to $70 if momentum continues weakening. This is a live demonstration of how dependent precious metals have become on Chinese demand. Number 2. Positioning is at extremes that raise risk of reversal. Fund managers hold their most bearish dollar stance in 14 years and their most crowded gold long position for 2 consecutive months. Such consensus doesn't guarantee reversal but raises the probability. If the dollar bounces or gold longs start reducing, the unwind could be violent. These positioning extremes should inform your risk management regardless of your directional view. Number 3, despite short-term weakness, the structural case remains intact. Central bank buying continues with China accumulating an estimated 250 tons in 2025 alone. Government deficits and sovereign debt levels are rising. Treasury Secretary Besant suggested China may be developing gold-backed digital assets. Apollo's chief economist suggested central banks may soon hold more gold than dollars as reserves. These structural forces support precious metals long-term, even as short-term volatility creates uncertainty. The key question is what happens when China returns from holiday. Strong buying would confirm the correction was temporary. Continued selling would suggest something more significant has changed. The unresolved tension is this: we have extreme positioning, absent marginal buyers, and weakening technical pictures in the short term. But we have structural demand from central banks, de-dollarization trends, and potential monetary system transformation in the long term. The next week, while China is on holiday, will test how deep the support really is without the marginal buyer. And when China returns, we'll see whether they come back buying aggressively or whether something has changed. Do your own due diligence. Understand the risks. Be accountable for your own decisions. Have a clear plan and know your time frames. Are you investing for the multi-year structural transformation thesis or trading the short-term volatility? These require completely different approaches, different position sizes, different risk management. If you don't have a plan, this kind of volatility will destroy you. Gold breaking below 5,000 is significant. Silver falling 5% in a day is significant. But significance works in both directions. It could be significant because it's the start of a larger correction, or it could be significant because it creates a buying opportunity that won't last once China returns. The data over the next week will tell us which interpretation is correct. The market is teaching us something important right now. It's teaching us that Chinese demand has become the critical marginal buyer for precious metals. It's teaching us that without that demand, prices struggle. And it's teaching us that positioning extremes create risk in both directions. Pay attention to these lessons. They'll be valuable for navigating whatever comes next. Use your brain. Don't follow anyone blindly, including me. Do your own research. Make your own decisions. Watch the levels I gave you. Watch what happens when China returns. And position accordingly based on your own risk tolerance and time horizon. Let me know in the comments what you think happens this week. Does gold hold 4,860? Does silver hold 70? What happens when China returns? I want to hear from you. Mr. AG Asian Guy, out.